morning, everyone. Thanks so much for joining today's session on Cash Flow Made Easy. My name's Kristy. I'm a presenter and an advisor for Business Station as part of the Digital Solutions Program. And we're bringing this webinar to you today as part of that program. Just a quick disclaimer, I own and manage my own businesses. I'm not an accountant or a bookkeeper. So a lot of what I'm going through today is really comes from my experience with the operational side of operating businesses. But I would really recommend that you seek any accounting advice from your own accountant. We're going to go through a lot of different things today. We do touch on the accounting side of things, but cash flow is very much an operational function anyway. Keep in mind the webinar is designed to be interactive, or as interactive as you'd like to make it. So please use the chat functionality to ask questions at any time as we go through, but I'll also stay on for a few minutes at the end of the session and answer any questions that you might have then as well. Okay, so in terms of what we're going to go through today, throughout the webinar, you'll really gain an insight into the cash flow process and how you can manage it yourself within your own small business. We'll discuss what cash flow actually is, and talk about the difference or perhaps even the relationship between profit and loss and cash flow. You'll also learn how to create your own cash flow forecast if it's something that you're not doing already. And we'll talk about how you can develop more of an analytical approach to cash management. And that's really through effectively tracking your performance, whether that be weekly, monthly, quarterly. We'll also go through some strategies to stretch your cash flow further. So no matter where you're at with your cash flow, you may be managing and tracking your cash flow already. Hopefully you'll be able to pick up some things within that section where we talk about how you can stretch your cash flow further, or this could be completely new to you and you're learning the concepts as well as some of the implementation. So it is fairly straightforward, so hopefully you can follow along. Before we get into a bit of that side of it, I'm talking about what cash flow is. Well, cash flow is essentially, it's the term that's used to describe the amount of cash in actual dollars that's generated or consumed in a given time period. So cash flow does have a lot of uses, mostly in operating your business, but also in performing your financial analysis of the business as well. And I believe it's one of the most important metrics in all finance and accounting because it really is the lifeblood of your company. Managing your cash flow allows you to evaluate that flow of funds in the business and really allows you to look forward and identify when and where there are potential problems. So if you can understand your cash flow, it becomes a really integral part of your business success. Once you find out how to manage it, then you'll be able to learn how to stretch it even further. So looking at that relationship between cash flow and profitability, now these two terms do get a little bit confused sometimes, but profitability is the ultimate goal when it comes to the financial side of running a business. But the thing about profitability is you don't normally generate or determine, I should say, true profitability until the end of a period of time. Most of the time, that's the end of a quarter or the end of a financial year, even in some circumstances. So that really is the key difference between cash flow and profit. Profit is retrospective or looking backwards, whereas cash flow is forward focused. Profit is really the amount of money that you've got left over after you've paid your expenses. It could be at the end of a financial year, and making a profit really means that you've made enough sales of your product or service to cover all of your existing costs, your expenses, and you've had a little bit extra to spare. Cash flow, on the other hand, indicates that net flow of cash into and out of a business at any given time. Now, it could be outlined in weeks, it could be outlined in months, years, might not be as detailed enough, but it really comes down to how you set up your reporting. I would recommend, and the most common is generally month by month. Some businesses, you might look at performing a weekly cash flow analysis, but that might be, there might be too much detail in that. So monthly tends to be, the most popular. Why does cash flow matter? Well, cash flow does matter, and it matters a lot. If you've got positive or good cash flow, it means that you're going to have enough money to pay all of those expected expenses. As I mentioned, you're going to be able to pay them when they're due. You'll know when you're able to reinvest in your business, potentially purchase capital or other assets that you might need to actually grow your business. or even to run it more efficiently and be more profitable. The other thing about having positive cash flow, it means that you'll know when it's appropriate to return money to shareholders or take money out for yourself as well. You'll be assured that you've got a bit of a buffer to cover you against future financial challenges as well, which is another crucial element of cash flow. If you've just got enough that it's coming in, it's going out, and you're really cutting it fine, then if you've got any kind of unexpected, let's say it's equipment replacement, there could be legal expenses or anything unforeseen, you might not be able to cover them. So you really need to have some kind of mitigation. If something does happen, you'll have to know how you can get the funds to cover in that circumstance. Now, if you've got cash flow problems, that means that you don't have enough money in the bank for those necessary things, let alone anything that might pop up that could be unexpected. The other thing you need to keep in mind with cash flow is that you can have profitability, but suffer from cash flow problems. Now, the most common scenario around this is if you've got clients that pay late, or if you've got bad paying terms to your suppliers, so you're asked to pay early, or shorter paying terms. So they're kind of the two main reasons why that can happen. Once you figure out your cash cycle, payment terms is one of the first things that you're going to do to keep cash flow positive. Now, when we talk about tracking your cash flow, if you've got an existing business, it's really important that you continually analyze your cash flow. If you're a startup, your first goal will be maintaining a positive cash flow. And then once that's under control, you'll then be looking to make it as profitable as possible, but really just covering enough, just getting your sales to that level where you're at least covering your expenses will be that first element, or the first goal that you might have as a small business, as a startup business, sorry. Okay, now we're going to have a look at tracking cash flow. So tracking cash flow is the crucial element in what we're talking about here. It allows you to operate profitably and generate positive cash flow, or if you're not operating profitably, you need to make some changes to improve your cash flow. You might identify that you need to reduce certain expenses or increase revenue in particular areas, and you'll have to make adjustments accordingly. It also allows you to look at what's working well and what's not, in terms of your perhaps things like payment terms, but also your suppliers, and in addition to that, what products and services are selling well, and at what times you're selling them as well. You can then set budgets based on what you know you need to achieve at certain times to maintain or to achieve positive cash flow. And then you would retrospectively report on that and track it and make sure that you're meeting that budget or that planned or the cash flow that you had anticipated. That will make sure that you've got enough cash. And if not, there might be times when you just can't get the additional cash, or you realize that you've got cash flow problems. At those times, or in those particular circumstances, you would then be looking at how you can get an injection of funds. Could it be personal input? Could it be seeking some investors, selling assets, applying for loans or overdrafts and that kind of thing to a bank? So you would have to, first of all, identify that there is a problem, and then you've got time to figure out how you're going to address that problem. It also allows you to make informed decisions on many areas of your business, but things like purchasing, there could be opportunities in purchase power at times that you've got, extra funds. You can purchase more in bulk. Things like staffing, level of sales, what you're selling, whether you're leasing and renting space. So you're really making informed decisions around all areas of your business. And with all of that knowledge, you should be able to reach your business goals and hopefully exceed them. Now, the best way to address that is to look at creating a forecast, or the best way to analyze it is to map everything out by way of a forecast. And cash flow matters a lot, so it's only natural that you would do everything in your power to increase your cash flow. So this forecasting element will mean that you'll know exactly when you have the inflows and the outflows, and it's all clearly mapped out. Now, there's lots of different templates available online. I find that the best are those that are available on the Australian government websites. The business.gov.au has a fantastic cash flow template, which I'll show you in just a second, but also banks and a range of other websites have them. Normally, they're downloadable in an Excel format. Generally, they're free as well. Certainly, the Australian business websites are completely free. So I'll show you that example in just a second. But once you've got your template to get started, you will decide the period the forecast should cover. You'll add in all of the cash inflows, and then you'll start inputting some of the known cash outflows for each period, and that is usually month by month. If you've got an existing business, the best way to do that, or a really good starting point, is to get all of your data from previous years and input it into your forecast. So you might have accounting software you can export or extract reports around what some of your expenses have been and your sales for that matter, and then you can start inputting them into a cash flow forecast. That's not to say that they're going to be exactly the same in the year that you're forecasting for, but it's a good starting point. Once you've input all of your data into that forecast, you might decide then what adjustments need to make based on, there could be expenses in there that you know were one-off, or that you've managed to reduce, or that they've increased. So you'll be able to sort of go through every item and make relevant adjustments. In terms of sales, you might need to, you could input your past sales data, but then again, make adjustments based on, are sales increasing? Have they, is the trend decreasing, or do you think they'll stay the same? So there's the element of data, and then there's some analysis in there as well. So analyzing that data, and then some assumptions that will really result in that ultimate or that end forecast. Now, that's if you're an existing business, it's quite easy because you do have previous year's data. If you're a new business, when you're preparing your cash flow forecast, you have to start by estimating all the cash outflows. So you might have to get quotes on things like insurances. You might have to, hopefully, if you're starting a business, you will have done some research around what your costs are going to be, or the underlying costs of renting space, of producing different products, that kind of thing. So estimate all of the cash outflows and input that into your forecast. Once you do that, you'll then get an idea of how much cash actually needs to come in to at least cover what's going out. And that will therefore tell you what sales you need to make to cover your expenses. Keep in mind that sales figures do always change because there's so many variables. It could be, the types of customers you sell to could be changing, how quickly those customers pay you, what the economy is doing, things like fuel price increases or interest rate increases and unemployment rates could all impact how much of your product you actually sell. As well as, if you've got competitors in the market and that sort of thing. So when you are forecasting, do be very realistic because it's only going to be you that's caught out if you're putting unrealistic sales figures in there. So do be as realistic as possible. Then when you get to that point of checking your actuals against what you predicted, they should be fairly close. If not, at that point, you've got the opportunity to take some kind of further action and analyze again. We'll get into that a little bit later as well. Okay, so now having a look at a template. So this is one from the Australian government website. As I mentioned, just business.gov.au. You can search for cash flow, and there's a template like this, but there's also a good descriptor that goes along with it. So instructions on how to use it, but I'll talk you through that quickly now. So this is typically what it would look like. In this particular example, any of the blue cells that you see, this is an Excel document, are editable, or they don't have a formula in them. So you might start, we're in January now, you might want to start your cash flow forecast from February, even though, the most common is a financial year. But if you want to start quickly and you want to start working it out from what's happening next month and go on from there, you can certainly change that and edit all of that. And eventually, once you get things under control, you might reforecast again in May or June and have a new template or a forecast that's prepared for the new financial year. Up the top here will be your opening balance. So that's what is in your actual account. So cash flow is all about that flow of cash. So you will always have an opening bank balance, the actual cash that you have on hand. You input that first, and then these figures will all roll over month to month. So first of all, incoming, you've got sales, which you might be selling things week by week, but you'll have, monthly sales in this example. If you're planning to sell any assets, there could be some big sums that drop in there at a particular time that you're planning to sell an asset. Debtor receipts. So sales and debtor receipts are two different things. This is about the actual flow of cash. So if you're selling something in July to consumers direct and they're paying you at the time that you're selling the product, then it would go in the July sales. If you're selling something in July, carrying out that, giving that product or carrying out that service in July, but you're not invoicing to the end of the month, the debtor receipt wouldn't be until August. So make sure you're always factoring in when the funds are coming into and going out of your account. The next line item there is loans. If you are getting any loans that will inject some cash into the business, you can pop the amount in there. You will then have another amount for loan repayments on the expenses side as well. So keep that in mind. And then any other income that you might have. So any other income could be GST rebates or tax refunds. There could be owner investment of cash if you need to add extra equity into the business. There could be government grants or funding or, absolutely anything that goes in there. But cash that's going into the business is accounted for in that top section. The outflows, there's some examples in here, but all of these cells are editable as well. So if there's something in there that doesn't quite suit your business, in terms of, you don't purchase stock, for example, or, there's things in here that don't suit you, certainly edit them out and make this relevant specifically to the categories that you want to group and report on. Your outflows here will include all of your running expenses, but also consider if you are buying new assets, you will have to account for them there. If you've got any one-off bank fees like loan establishment fees or anything like that. Obviously your loan repayments, which I touched on earlier. If you are taking money out yourself as an owner of the business, certainly account for them here as a payment that you want to take out, as you would wages or anything else that's coming out. If you're planning to take money out, particularly if you're doing so at regular intervals, then certainly account for it here so that you can actually afford to do that and look at how it's going to impact your cash flow for the rest of the year. Also, don't forget to account for GST and other liabilities that you might have, PAYG, super, those kind of things. Now, they can be paid, some of them monthly, sometimes quarterly. So really have a look at when they're paid and account for them from a cash flow perspective at the relevant time period. So your forecast will take your opening balance. It will add all of your sales onto that opening balance. So you'll have your opening balance plus your total incoming, less your total outgoing, and that will give you your monthly cash balance. And then you've got your closing balance as well, your total incoming less your total outgoing will give you your monthly cash balance. That then is added onto your opening balance to give you your closing balance. So if you've got, let's say, you have a big month and you've got a lot of profit in there, that will roll over. And then you might have months down here, let's say winter, for example, is particularly quiet, whereas summer you make a lot of your income. You'll see that you might have a month where your cash balance is negative, but your closing balance remains positive because those funds have been able to roll over and you've had to dip into those funds at quieter periods to account for a downturn. So it will change the line item to red if there's a negative. So I would be inputting all data here and certainly having a look at when there are times that the monthly cash balance is in the red and what you can actually do about that per month. And then have a look at the big picture with that closing balance as it rolls over. So that's really straightforward. And it's absolutely fascinating to get all of that information in there. If you've never done it before, but you've run a business for quite a while, that's very, very common to not have had a look at your cash flow. But it is a really, really interesting activity to do it. And it will tell you a lot about your business. A lot of it you might already know, that there's a downturn in winter, so that you always struggle to put funds together, but are you carrying enough over from the busier months to account for that? So those kind of things you can really look at. Hopefully that makes sense, but please feel free to pop any questions on the chat if there's anything that needs clarification. Let me just have a look where we're up to. So now we're going to have a look at strategies for improving your cash flow. And this is really kind of the good part about what we're talking about today. Once you've mapped out your cash flow and you're all set up to track it, you'll then identify if you need to improve it. Now, whether there's a profit or a loss showing on your cash flow statement, or whether there's any months that are in the red, or perhaps all months are positive, I would still be looking at ways to improve it, because that equates to more profit for you. The strategies, for improving cash flow fall into three categories. There's revenue growth, there's operating margins, and there's capital efficiency. So we're going to look at some of the key areas within these three main pillars, but it's certainly worth looking at all areas of your cash flow. Obviously looking at what's relevant to your specific business as well. Not all of these things will be relevant to your business. So sort of pick out what is most relevant to you. Now, I believe that a lot of what we're going to be talking about is marketing, and it's really strategic marketing. But first, you need to understand your position to be able to improve your marketing, which will subsequently improve your cash flow, if that makes sense. So just to expand on those three main pillars, you've got revenue growth. Now, revenue growth incorporates the volume of goods or services that you're selling, and the price of what you're selling as well. And some sub sort of categories under that. Then you've got your operating margins. Now, your operating margins factors in the cost of goods sold, and you're selling your general and administrative expenses as well. So in this area, there'll probably be a lot that sort of pops up just on that cash flow forecast alone, to really I guess identify or open up areas that you can make some adjustments. Then you've got capital efficiency. Now, this is pretty straightforward. It's really just a question of how efficiently you're using your cash to operate and to grow. So that looks at property, plant, and equipment, and also inventory, if inventory is something that's relevant to your business. Now, we're going to start looking at some of these areas in a little bit more detail. As I mentioned, we won't be going into absolutely everything, but we will touch on the key areas that are relevant to almost all businesses. Starting with pricing. A lot of businesses that I start working with really don't know if their pricing's right, or if their prices cover costs, or if specific products and services are actually profitable, or which products and services are most profitable. So thinking about that, and think about your own business, and pop it into your consideration. What are your most or your least profitable products or services? The next question is, how can you increase the products that are most profitable and perhaps decrease the less profitable products? Sometimes that's not relevant. Sometimes you want to have low profit products to get people in the door. So sometimes there's a strategic decision around that. But the example of getting rid of a low profit product would be the time spent on it. So think about how much time is invested in each. If you've got a less profitable product that is a high time investment, then it needs to go. If you've got a low profit, low time product that gets people in the door and you can upsell and onsell and those kind of things, then it's probably got its place. Thinking about your pricing, ask yourself those questions. Why have you set your pricing as you have? There's a few different ways to price your product or service. There's cost base, which is what it costs you plus a bit of a markup. Now, that's very common in the fashion sort of industry, where, they go, we always want to make a 50% profit margin on our items. So it's pretty straightforward. But not a lot of industries are that straightforward. You also would have to consider what your competitors are doing, where, having a look at what your competitors are doing and also what they're offering. But you also have to look at what the customer is willing to pay. And really balance out those three areas. You can't just base your pricing on what it costs you plus the markup, because it might not be competitive. You can't just base your pricing on what the customer is willing to pay or what your competitors are doing, because you might not be covering costs or making a profit. So you really it has to be a bit of science behind that and having a look at all three elements, and then playing around a little bit to get it right. You absolutely have to know what your competitors are doing, of course, but you have to know your worth as well. So this is where identifying your own weaknesses or any gaps in what you're offering can really help. Do research on your competitors and make sure that you're offering a fantastic product or service that is superior to your competitors, and then perhaps you can charge more. So that really goes back to your marketing strategy. What is it about your product or service that's unique or different? What sets you apart from your competitors? And can you charge more because of it, regardless of what your competitors are doing? Or perhaps as a business, you want to base your pricing on more volume, less profit. And therefore you want to, come under your competitors to get more people through the door. So when it comes to pricing, discounting means more work to maintain a margin, whereas increasing your price means less work and fewer customers to maintain the margin. But by increasing a price, you could potentially cut out a market. And on the flip side of that, if you decrease the price, sometimes you can attract the wrong market. So there's some really good examples of that when you look at, some of the bulk buying sites, Groupon, Scoopon, those kind of things. Sometimes you can really slash your price and get a high volume of people through the door, but they're not likely to be loyal, repeat customers. Perhaps they're a little bit harder to satisfy, and they spend a little bit less. So keep that in mind as well. It's not always the best strategy, but it is certainly, it does work for some businesses. So there has to be that consideration. So pricing is all about knowing, obviously, what's going on around you in terms of what your competitors are doing, but what is going to appeal to your customer base. So you have to know who your customers are very well, and what your worth is as an organization. Then we've got volume. So when we talk about volume, thinking about if you can increase your overall volume and more specifically, the volume of more profitable products and services to make more money, or perhaps there's new markets to sell to, so you could create new products, or you could even streamline processes to allow you to produce more. Now, in terms of volume, other things that you consider, aside from sales processes, but I would have a look at increasing advertising. Obviously, that has a spend attached to it, but it should, if it's done right and strategically, it should equate to more exposure and hopefully more conversion or customers. Should consider if you've got salespeople, and if you do have them, are they good? If you've got good salespeople, make sure that you have a plan in place to both attract them and retain them. And look at things like customer loyalty. How can you get people back? Is it something as simple as a rewards program, or your communications perhaps to keep them coming back to you? Another way to determine profit enhancement, or, if you're looking at profit enhancement, there's a few different options that are outlined in the table that you see. So here you could be looking at a number of different ways to increase your sales, the volume of sales, and therefore your profit. But I'll go through each of them and what they sort of mean. And I would certainly consider within your own business, could you look at any of these areas to increase your volume? Now, the first one is market penetration that you see in the blue there. That's when you've got existing products and an existing market. So that's basically you as a company penetrating a market which there's current or similar products already exist in. So essentially, you're gaining your competitors' customers. The next area in green is product development. So developing new products for existing markets. So thinking about whether it would suit your business to launch a new product or service. Perhaps you've done some research and identified that your competitors have launched a new product or have a product that you could potentially offer to. Perhaps you're just trend tracking and having a look at what's going on in the industry or with consumers and launching a new product based on that. The next element is market development. That's where you've got an existing product and potentially a new market. So you're trying to develop new markets with your current products. Now, this could be something as simple as broadening your scope to the international market when you currently have a majority of local people, and that can be done through developing an online store as well as your bricks and mortar. We saw a lot of this over COVID times where businesses that were shop fronts all of a sudden went online and now have an entirely new market to what they've ever had before. So think about that. How else, what other markets might suit your business? And then the last element is diversification. Now, that's where you've got new products and a new market. So with your business, could you spread into new areas and sell something completely different to your existing core product? Now, the risk with that is that it takes away time and energy from your core product or service, as opposed to, adding or developing a new product that sort of ties into it, and that is something else you can sell to your existing market. So just make sure that it isn't distracting you from your core business. If the two can exist and it makes sense, then why not? But just really consider that diversification, that it doesn't diversify or, I guess, take away your focus and your attention on the other part of your business and replace one with the other. You want it to grow. It's a profit enhancement strategy, if that makes sense. So that's volume and ways to increase your volume. The next area to improve your cash flow is debtors. Now, a pretty interesting ATO statistic for debtors is that small businesses in Australia are owed about $26 billion at any one time because of debtors. So really try and get that money that you're owed in the door. The best way to address any issues with debtors are, first of all, to collect payment as quickly as possible. Now, debtors might not be an area that affects all businesses. If you work with a consumer direct, perhaps you have no credit terms, everyone has to pay upfront, which is fine. But if you do, certainly collect those payments as quickly as possible. Ways to do that or strategies around that are obviously, you see some of the bigger companies offer discounts for prompt payments, or even the introduction of late payment fees. Now, that's not always suitable for all businesses, particularly small businesses. There could be a negative, feel about that if you start introducing late payment fees, although it is very common. But really consider how you can encourage or incentivize people to pay early. Certainly invoicing earlier helps with that. Maybe not invoicing end of month, perhaps sending invoices straight away. Now, I've got a really interesting example of a company that does this that I work with my other business. And basically we have staff that go into this company and buy things throughout the month that we need for our operations. Every time a staff member walks out of that store, I get an email in an invoice basically come into our accounts inbox. So they are invoicing immediately. Even though we could make, 300 purchases in a month, we wouldn't make that many, but, we could go in there every day. So let's say 30 purchases in the month, but their system is so automated that those invoices go out straight away. We do get a statement at the end of the month to summarize what's owed, but it means that as a purchase has been made, that goes into our system. So I think that's a really good sort of, example to consider. What you don't want to do is make it too time consuming for you, because there's a cost associated with that as well. If you had to manually do an invoice every time someone, purchased from you and they're making 30 purchases a month, then that's probably not that cost effective or good time management. But automate the process as much as possible so that it isn't time consuming for you. So look at ways to invoice earlier. If you do have to create invoices manually and you do have customers that repeat purchase from you throughout the month, perhaps do a mid-month invoice and then an end-of-month invoice as well. Split it up. Otherwise, you might be delivering a product or service on the 1st of the month, not invoicing to the 30th or 31st of the month, and then you've got 7, 14, 21 or 28-day payment terms. So it could be up to 2 months before you get payment for something that you've delivered. So that means that you're the one out of pocket, which can cause really big cash flow problems. So consider tightening that all up a little bit. Reducing your payment terms is sort of what I've covered off a little bit there as well. So certainly have a think about what your payment terms are. I am always shocked when I get an invoice that has a 30-day payment term. That is, to me, a little bit old school, although, you know, as an organisation, I like that because that gives me more time to pay and therefore I can use the money for 30 days. But really think about your business, you know, and think about, it doesn't need to be 30 days. 7, I think, is fairly appropriate. 7, 10, 14. I wouldn't really look at extending it any further than that. Electronic invoicing is another thing to consider. Obviously, switching from paper to electronic and as automated as possible, offering follow-up services is fantastic. Electronic invoices are a lot more professional. They're easier to send, to store. Obviously, there's a reduction in turnaround times there as well. But having some automation to make sure that payments are followed up promptly if they're not paid on time is highly recommended. So the more automated the payment follow-up, the quicker you're going to get paid, and the less time that you're going to need to input to get payments in. There's also e-invoicing, which you may have heard of. E-invoicing is the automated digital exchange of invoice information directly between a buyer and a supplier's accounting systems. So it is fairly new. With the introduction of e-invoicing, you won't even have to generate a PDF or paper invoices. Once you're connected to the same e-invoicing network, you can start using accounting software like Xero or I'm pretty sure MyOb, you can do e-invoicing now to send and receive these e-invoices. Now, another interesting stat from the ATO is that apparently it can cost about $30 per paper or even a PDF or an email invoice compared to about $10 for an e-invoice. So if you can get connected to those systems, it can be really a major cost saver. Someone's just asked what software do I recommend for electronic invoices or for accounting software, I guess is probably the question. Now, I personally use MyOb, but there's lots of Xero fans out there as well. I think, you know, they're the main two that I sort of hear of and work in and around. And they're very efficient in terms of, you know, I guess automatically linking with your bank account so they can track transactions that are coming and going, automating invoices to be sent, automated follow-up. So it is all very streamlined in that sense. There are some others out there. There's QuickBooks and there's a few others that are sort of popping up, but find something that works with you that fits your budget in terms of how much it actually costs per month or, you know, subscription. The one thing about software is get it right the first time. If you're planning to grow your business at all, it is a major headache to change accounting systems, or it can be, because sometimes you are missing a bit of historical data and that kind of thing, depending on what you're changing from and to. So I would look at going for a software package that suits your business and can grow with your business as well. Another two elements of that are go with something that your accountant and your bookkeeper are very comfortable using. So that's a really key thing to keep in mind, is that there's no point you researching a great accounting software and then you say to your bookkeeper, here you go, this is what I've chosen, and they go, well, we don't know how to use that. So if you do have a bookkeeper and or an accountant, certainly go to them for their recommendations in what they're comfortable working with as well. Yes, I will put some software names in the chat, but essentially MyOb and Xero are the two main ones that I would look at researching. Have a look at those online and have a look at some of the pricing around them and the services and the functionality of each of them as well, but certainly speak to your accountant or bookkeeper. Okay, now looking at assets, this is really straightforward. I would simply be looking at your assets and thinking about if you have any underused or unused assets, can you sell them? That will free up a bit of cash. Thinking about most businesses tend to accumulate assets that they don't require, so sell them off. Increase some cash in the business, but it also saves on costs like insurance, storage, that kind of thing. So certainly look at that. Look at leasing to free up cash. Now, leasing smooths out cash flow, meaning that you will have a standard charge every month, or your charge, if it's based on usage, would increase as your usage increases, which you would anticipate would be at the same time that your sales would be increasing. So if it's appropriate for your business, it can be a really great way to free up cash. It removes the risk of complete failure of a piece of equipment that might need replacement. You don't generally, if you're leasing something, it will remove maintenance costs and some of that risk. So particularly if you're a startup, rather than going, all right, we need this asset, that asset, have a look at, with some of them, can you lease them? And therefore, it's really the charges are being incurred as you're making money. It reduces a lot of the risk. Also look at refinancing. If you do have loans in place, negotiate better terms with any existing loans or bank agreements that you might have as well. Okay, expenses are the next area to have a look at. Now, this is pretty simple as well. And put very simply, expenses decrease the amount of cash that's available to your business. So think about what you can do to reduce those expenses. Can you defer expenses or look at better payment terms? Can you rent a cheaper location or negotiate a better deal with your current lease? Perhaps, are there other alternatives to any expenses that you've listed? And I would literally go through your cash flow forecast and have a look at each expense on there and go, okay, there's a phone bill. Is there a new plan available or a new technology package for a particular software that you're using? Can I remove this expense would be another question. Sometimes you have so many memberships and subscriptions and things that you just pay month by month and never really look at them as a whole and go, yes, it might only be 10 or 15 or 20 or 30 or $40 here and there, but add it all up. Over a year, that money would be far better spent in advertising, for example. So really have a look at all of those expenses, what they are you using them, and are they needed? Or could there be a better deal? Also look at things like reviewing insurances as well. That can be pretty straightforward, or anything else that you have that's like that, reviewing contracts, I guess. Lastly, looking at the comparison in outsourcing versus in-house staffing. Now, it can be a very effective thing to do for specialist roles, like we spoke about bookkeepers, rather than having a full-time employee there that, there's liabilities associated with an employee. Perhaps just outsourcing a bookkeeper where you're literally only paying them for the work that they're doing. You tend to get someone that's at a higher level in terms of experience because they own their business. If you've got a lot more automation, you probably need them for a reduced amount of time. So bookkeeping is a really good example of that, as is marketing. There's a lot of social media specialists out there. There's advertising specialists. Rather than employing a marketing manager that is doing all of those functionalities, can you outsource bits and pieces of that? Or there could be other administrative roles where you could perhaps outsource. It's not for everybody, and it may not be suitable for your business, but I would certainly consider it as well. That way you're really paying as you go, or paying for what you use, if that makes sense. Now, inventory is the next area we're going to have a look at. Now, inventory isn't relevant to everybody, but if you do have stock, keep in mind that inventory represents cash. So if you're holding it, you're basically sitting on cash, so it can cost you significantly. So if you've got inventory, think about a few elements. First of all, can you source any cheaper stock or materials? So always review your pricing from suppliers. I would regularly do that. Now, you might have a supplier that you've worked with forever, you know them, you trust them, they continually deliver a great product or service. That's absolutely fine. However, I would still look at getting price comparisons and then perhaps going back to your original supplier and say, we've got a great relationship, we want to keep working with you. However, I can source this a bit cheaper. What's the best you can do? So don't let them get complacent in their relationship with you. Keep them on their toes by always checking whether or not you can get something a little bit better. Now, that's not to be disrespectful to them or to go behind their back or anything like that. It's really to make sure that you're always getting the best possible deal. They'll soon let you know if they can match it or not. Purchase power, we touched on a little bit earlier, but you've got buying power when you understand your own cycle. So when you map out how much cash you have at certain times versus how much stock you actually use, you might be able to see if there's any efficiencies there. So if there's particular times where you do have an influx of cash, buying more, buying larger quantities of your stock at that time might mean that you save a significant amount of money, but always weigh it up. So always have a look at how much am I really saving? Is it enough to actually have all of this stock sitting there as well? So that sort of ties into the next point of managing your stock levels. You always need to make sure you're maintaining the right levels. So your stock shouldn't be too high, but also you should never run out either. So track the movement of your stock if you can. If you've got software, again, software can be really helpful here. Or make sure that you've got your own processes in place to identify when you need to purchase more stock and what's selling and what's not. Now, with your suppliers, have a look at what their terms are. And if there's stock that you can't sell, is there a return policy? Most of them are very strict with return policies now since COVID again, because everyone tried to return stock at that time. But really just think about if there's something that's not moving, how can you move it faster? Maybe you have, a physical store. Can you go online as well? Or vice versa. Maybe you're an online store, do a pop-up to try and move some stock. If you can use software platforms, to manage your stock, then that will really help. Otherwise, you can possibly do it manually. But really understand what sells well and what doesn't. You've got drop shipping or just-in-time stock orders. They can be really good. However, you need to, first of all, find a supplier who will provide you that service or stock only when you need it. That way you're not wasting money, buying stock, sitting on it, or even, you might save on warehousing and your storeroom. You're only ordering once you've had an order from your customers. A couple of issues with that are the delay on delivery. Delay on delivery can be a concern if you're doing any kind of drop shipping. Also the quality. Someone's just asked me to repeat the drop shipping stuff. So you can look at drop shipping or just in time stock orders. You will need to look and see if there's a supplier that's going to provide you that stock only when you need it. And the reason being is that you're not going to have stock that you need to store in a warehouse or a storeroom or in your spare bedroom or wherever you're storing stock. When you order or when your customer places an order, it goes straight from their warehouse to the customer. But the two concerns that I have with that are delivery, make sure there's no delay on delivery, and quality assurance. If you've got the products, then you can check them over, make sure that the stock, the order is being fulfilled, it's accurate, it's going to the right person, etc. Sometimes with your drop shipping or your just-in-time stock orders, there can be, it's a bigger processing plant, so there can be errors in terms of what the customer get. I've heard a couple of horror stories about what, customers getting completely wrong products and that kind of thing. So just make sure that you're using someone that's reputable in that circumstance. The last point there is just your payment terms. So use your supplier payment terms. So make sure that you're making full use of those terms, because that really equates to an interest-free loan for you. So don't pay early. So keep that in mind. If you're ordering stock, let's say you've got one supplier and you don't have any personal relationship with either supplier, but you've got one that's got a 30-day payment term and one that's got a 7-day payment term, go for the 30-day one, if everything else stacks up and they're exactly the same, because that gives you an interest-free loan essentially for an extra 3 weeks than supplier A, just as an example. But always consider what those supplier terms are as well. What happens with any kind of inventory is that you buy it, you pay for it, so you're out of pocket until the customer purchases it and pays for you. So you want to reduce that gap, close that gap as much as possible. Okay, so looking at staffing next. When it comes to staffing, this is a really key area that can become a major expense for businesses. Now, we touched on staffing a little bit when we're looking at outsourcing, but in terms of staff management, rostering to cover demand is really important. Obviously, you've got to cover demand to produce revenue, but you don't want to overstaff either. You need to match the roster to the peak periods and possibly have flexible staffing arrangements in place to cover otherwise. Outsourcing can be great, as I mentioned, if there's those flexible roles or those specialist roles, so that you're only paying on demand rather than having a full-time employee, something that doesn't work for all businesses but can work fabulously for others. So certainly consider it in your business and see if it works for you. Flexibility of workers is really important in terms of what sort of roles they might have. So can they have multiple roles, or are they able to multitask as and when you need them to? Now, a good example of that is you might have a storefront, but you might have an administrative staff member out the back. Obviously, as there's a peak sort of period in the front of house stuff, can that person assist out the front as well? Can they hold multiple roles in times where it's generally a little bit quieter? So think about that and make sure you're employing accordingly. But aside from multitasking or having flexible workers, make sure that you're utilizing staff to their maximum capacity as well. So looking at things like setting targets to maximize the productivity of staff members. Incentivizing sales, perhaps you've got things like a commission structure or that kind of thing that you can sort of implement. Or you could even consider rewarding staff behavior that reduces expenses, so it improves cash flow in that way. Now, commissions are a great way to increase sales, but if you are paying commissions, make sure that they're only paid when you have the payment from the customer. So again, this isn't another thing that impacts your cash flow. Employ more qualified staff. So have a look at the qualifications of your staff and look at paying someone that is more qualified if it helps in terms of the sales and efficiency. So I think about this in a restaurant example. If you're at a restaurant and you've got someone that's come to take your order, so a wait person, you start to interact with them about the menu and ask them a few questions, and they're not experienced enough to know how to talk you through it or help you choose more or on-sell and upsell, you might not order as much. So an unqualified staff member might look like a really quick win on a cash flow forecast, but in fact, it can be really damaging in the long run in terms of your sales, that on-selling and upselling, perhaps even to your customer service levels. So really keep that in mind as well. When you do find these good staff members that can on-sell, upsell, have high levels of customer service, they really, really improve your cash flow. So make sure you look at retaining them. Retention is, a really key element here. Reducing staff turnover is a major goal because it has such a serious impact to the bottom line. Staff are expensive to hire, they're expensive to train. So you can really avoid those costs if you look after your staff and become that employer of choice. So once you've got the staff that are the perfect fit for your business, do what you can to keep them. And things like those sales incentives, as we mentioned, can work really well. Okay, so that covers some different strategies to improve your cash flow. As you go through and complete your forecast, keep those strategies in mind. And then when you get to the point that you've determined if you have a profit or a loss, you'll need to make some considerations. When it comes to profit, don't be too quick to take the money out. I would look at investing it back in to manage cash flow for the future. Again, as we said, there might be some unexpected things that pop up. So if you are not too quick to pull it out and you do invest it back in, you'll have that surplus to really cover anything that does pop up. You could use it to pay down debt as well, which then reduces future, impacts on your cash flow forecast by way of it can reduce interest, loan repayments, that sort of thing. Now, if your forecast shows a loss, you'll have to consider how you're going to address that. You might need to input your own money. You may need to get new equity from investors, perhaps, or you may even have to borrow to fill gaps. So you'd have to speak to your bank about that, perhaps even look at an overdraft. So if you were to map out your cash flow forecast now, and you can see that in a couple of months there is a problem, maybe it's only a slight problem, the very first thing I would look at doing is speaking to your bank about an overdraft, because that can be a very common and a simple solution to things like seasonal cash flow, or even debtor cash flow issues. So certainly, normally banks will have an amount that's pre-approved for you for an overdraft, depending on the nature of your business, your bank, and also how long you've been in business. But generally, there's a pre-approved overdraft amount. So that's something you can take advantage of. However, keep in mind, any of those things will take time. So what if you're tracking now and you're looking at there's an issue in the future, use this time to get yourself sorted so it doesn't get to that problem period and you're stuck and can't pay bills. So really address that now. Now, the very final step and the most important step of all is to review what you've estimated against your actuals. Now, I would do this every month. Go back and check what you estimated against the actual cash flows for each of those specific periods, which is generally by month. And highlight any differences between what you've estimated and what it eventuated to be, or what your actuals were. And it will really help you see why your cash flow didn't meet expectations if it didn't. It could have been lower sales than forecast, or it could have been higher expenses. So you'll have to take different actions for different situations. So do keep that in mind. Now, cash flow is all about that timing and the flow of cash. So when you are preparing these cash flow forecasts, make sure you're as accurate as possible on that timing as well, because then it will all make sense and you'll be comparing apples with apples at the end of each month. Now, in terms of some cash flow mistakes, the biggest and most common mistakes that I see are running a business from your bank balance, because that doesn't account for any planned or unplanned expenses, or even perhaps the seasonal nature of your business, if you've got a high season and a low season, for example. The improper management of taxes and government expenses is another issue. These expenses are clear and they're known, so plan for them. Things like GST, super, PAYG, they're all, you should be accounting for them each month or each quarter when they're due. And there can be penalties for late payments, so make sure that you have them as part of your planning. Spending too much money on sales can be another issue. As a small business, you do need new customers, but you have to make sure that the acquisition cost is relevant. So how much is it costing you to get a new customer through the door, and how much revenue are they generating? So having a look at your advertising expenses, essentially. And that's where some good monthly reporting on what sort of level of sales you're getting and that kind of thing can really help when you're comparing that to your marketing spend. Obviously, not forecasting is another big mistake, but I'm sure after today's session, you will know that you absolutely have to forecast, and some of the other things that we've spoken about in terms of debtors and not collecting that cash fast enough, the inventory and those sort of things. So keep all of that in mind. If you do suffer from negative cash flow, you certainly can recover from it. So don't think that, if you're seeing red on your forecast as you're mapping it out, that's it, it's all over. You have to find out what's caused the issue in the first place. You will have to do things like change your payment terms, reduce those operating costs, run promotions, or perhaps speak to a lender or an investor, but make sure that that's a planned approach, not a last minute sort of desperate call, if that makes sense. So that wraps up our session on cash flow today. I hope it makes sense to you all, and I hope there's some things that you can take out of it to improve, or at the very least better understand the cash flow position that your business is in. Hopefully at any given time as well, if you are keeping on to your reporting. I'm going to stay on now and answer any questions that you have. Keep in mind, we've just scratched the surface. So if you want to know more or talk about any other aspect of your business, you can certainly take advantage of the Commonwealth Government Digital Solutions Program that we are a part of. Details are on your screen now. It's just $44. You can get 3 hours of one-on-one mentoring plus a range of webinars and workshops to make up a 7-hour package. If you do want to register, the link is on your screen now. That there is some eligibility around where you're located, Queensland, WA and NT for our program. You have to be operating for profit and employ fewer than 20 full-time staff. So thank you for your comments. Sorry, I am going fast. I realise that, but we do have a lot of info to get through in a short period of time. Keep in mind that you will get a recording of today's session within the next few days, so you can slow me down rather than speed me up, or even just stop and start as we go through. Thanks for the great comments. I'm so glad that you guys have got so much out of today's session. It's a very, very interesting topic, something that can be a little bit overlooked from businesses, no matter how many businesses you've had. It is a really, really simple thing, and get cracking on that template because I think you'll find it really interesting. Thanks so much for joining me today, guys. Any questions whatsoever, please pop them in the chat now, and I'll stay on for a couple of minutes. But otherwise, have a great day, and hopefully we get to chat again soon.